thank you so much again for taking the time to join us. We were looking at the number of signups, and it's really so encouraging to see so many of you here tonight. We always enjoy interacting with our audience. So it's just such a pleasure. So maybe allow me to introduce myself. I am Joanna, co-founder of The Smart Investor. And with me here this evening is Chin, my fellow co-founder at The Smart Investor. Chin, let's say hi and test your audio.
Hi everyone.
Okay, great, loud and clear. So, looking at so many of you, and I can see the numbers increasing right now as we speak, it's really so encouraging, and it says something about where investors are today. The stock market has been doing very well. There has been a lot of interest in the Singapore stock market. I bumped into someone a couple of weeks back, and the comment was that, hey, Singapore stock market is no longer boring. And definitely it's not in last year, Singapore stocks have had and is still having a very strong run. And many investors have seen their portfolios grow. So there's definitely a lot more optimism compared to where we were a few years ago. And at the same time, I think many investors are facing a very interesting, well, dare I say, problem. When markets are falling, right, people like to ask, oh, is it time to sell, cut my losses? But when markets are going up, then the main question that I keep hearing, or we keep hearing, is that, should we buy more? Is it time to buy more? Or is it too late to invest? And that tends to be a very common thought on a lot of investors' minds. So while before we begin, I would like to invite everyone here to participate with us in this. Just put a word into a chat, and then we can test, if you can look at the button, at the chat button at the bottom. You can, just to test that you can hear me. Can everyone hear me? Okay, so great. Because I thought I saw someone say it was okay, very good, very good. So glad everyone can hear me. Fantastic. I was a bit concerned about the audio. Okay, so just let me know how you're feeling about the market right now. Right, just one word. Don't give a full sentence, right? So that we can quickly capture everybody's thoughts. Excited, nervous, confused.
Scrumptious.
Huh?
Scrumptious.
Scru-
I'm just
Okay, we're
reading
not
off
talking about
words my
candy.
daughter has to spell.
Are you anxious?
Uncertain, too
Do
high,
you? Okay lah. I mean, I guess there are some people who say we should
overheated,
start earlier.
anxious.
That's not a word.
Wow. Wow is a good word.
Happy.
Volatile. High. Is it too late? Expensive. Not making money.
I think a lot of the comments that are coming in,
Excited.
it's really exactly what we are hearing from a lot of investors, right? And it's very understandable, all the emotions or that what we're feeling given the market situation today. Singapore market has had a good run. So even though the market is doing very well, there are people who are, I mean, we're all, it's very natural to wonder, right? So that is one challenge that investors are facing. So when your portfolio, I mentioned someone, I see that someone is making money, right? So when your portfolio is doing well, it's also a happy problem, right? Because then what is the next decision that you're going to be making? How do you continue to make money? The next decision can sometimes be even harder. So our topic for today is investing $100,000, right? So the interactive question number 2 that I want to ask you now is, imagine tomorrow someone gives you $100,000. We'll all be very happy, right? But the caveat is that you need to invest in the Singapore stock market. What would you do? We're running a poll, so I think you just select your options. A, put it in one of the banks, DBS, OCBC, UOB. B, build a portfolio of dividend stocks and REITs. C, keep it in cash and wait. D, split it across different investments. Okay, so while everybody is deciding what you want to do with $100,000, I want to share the results of a social media poll that we ran 2 days ago, right? It's a very similar question. The results from social media was 53% of respondents chose investing in the banks. 27% chose other dividend stocks, 13% chose REITs, and 7% chose no idea. So slightly different from our poll today, which so far is overwhelming on build a portfolio of dividend stocks and REITs. All right, you're very, very interesting. Now, I think many people can relate to the interest in banks right now. DBS, OCBC, and UOB have delivered very strong results, right? And many investors, including I'm sure some of you here, have benefited from owning them. So the most important question that we're going to answer tonight is, what stock do I buy? Is that really the most important question? No. The first question should be, what do you want your money to achieve? What are you investing for? Are you investing for income? Are you investing for long-term growth? Are you trying to build financial security for whether is it yourself or for your loved ones? So that answer with the goal in mind should determine how you think about investing. And that's what Chin is going to be sharing with us in his presentation tonight. Just in 1 minute's time, he's going to be sharing a presentation on how to invest, or how to think about rather the principles behind investing $100,000, especially when the markets are doing well like right now. So we'll discuss expectations, dividends, managing risk, dealing with uncertainty, all the words that I've seen pop up in the chat, right? And most importantly, how can you build a portfolio that matches your own financial goals? So before I hand over to him, a few housekeeping rules. So the chat is open, but if you have a question, I would ask that you send it in through the Q&A button. Send in your questions, as early as you can, because what I'm trying to do is to collate the like questions, and then we'll ask them like on the same topic together after Chin's presentation. Typically, we have a pretty big crowd this evening, so I do expect quite a lot of questions. So send them in early. I will try my best to get to as many as possible. Apologies in advance if we can't get to your question. This session again is also being recorded and it will be up on our website. So without further ado, wait, before I hand over to Chin, yes. So everyone has decided, the majority, about half, has decided build a portfolio of dividend stocks and REITs, followed by split it across different investments. Oh, very interesting. The least number of people want to keep it in cash. So, okay, very, very applicable to tonight, and I think it gives us a lot of context in which how we can conduct our conversation this evening. So, handing over to Chin. Chin, you can start to share your screen.
Thank you, Joanna. I can see this. All good?
All good. Yep.
Okay. So firstly, let me add my thanks to what Joanna said. That thank you so much for taking time out of your busy schedules to join us on a Wednesday evening. Really appreciate it. We'll try my best to make it worth your time, right? Now, the topic today, of course, is how to invest 100,000. That's what Joanna said. But let me also add the next 4 words: for long-term income, right? And this is really, really important part of what I want to talk about today, the long-term income, right? I'm going to come back to this topic many times today. So keep these words in mind as we start the topic, right? Now, what I've realized today is that this question of how to invest 100,000 seems like an easy question, but it is hard, and it's hard today because I'm noticing that there's a certain kind of tension in the stock market today, right? And that is why I wrote an article last week for the Business Times, because I'm noticing that on the one hand, if you look back at the last 2 months or so, you have had almost consecutive weeks of all-time highs for the STI, breaking through milestones like 5,200, 300, 400, all the way up to 5,700, right? And it seems to happen almost every week. share prices are rising. It's making people uncomfortable. But at the same time, companies are also reporting their results over the last 4 weeks or so. And guys, I have to tell you that I have the results, at least for the stocks which I'm following or on my watch list, they have been pretty darn good. So let me share with you what I mean by that, right? At the Smart Dividend portfolio, we have 24 stocks. Around 18 of them reported and declared dividends, right? The other 6 either didn't report or reported no, but did not declare dividends because it was not the time for them to declare dividends. But 18 of them reported and declared dividends. So what I've done is I've compiled the dividend increases in this graph here, which you see, right? So these are the stocks which reported and declared a dividend. I want to say 3 things about this to show why results to me has been as good as it can get, right? Because firstly, roughly about 9 out of every 10 stocks which reported and declared dividends have either maintained or increased their dividends, right? Why is that important? I'll go back to the word long-term income. What you want as an investor is for long-term income, which means if they maintain their dividends, means 0% increase, which you can see on the left-hand side of the graph. It means that what they paid last year, they are paying the same amount this year. They are maintaining it. That is important. That's sustainability of dividends, right? And of course, the vast majority has actually increased their dividends. And 9 out of 10 did so, right? Now, second point I want to bring up, you'll notice there's actually 17 stocks here instead of 18, right? So what happened to the one? Well, there was one stock which declared an interim dividend, but last year they didn't pay an interim dividend. So I left that out, right? It's real money, by the way, right? It's gonna enter the portfolio. But I left it out because if I put it in, it's gonna go to infinity and this chart goes haywire, right? So remember, I left one out, okay? At the same time, since we're talking about additional dividends, there are 2 stocks within here which actually paid additional dividends, either special dividends or additional dividends, right? I left them out also, right? Because if I put them in, it will go to 80%, right? And the reason why I left them out is because the 3 words again, long-term income, right? I'm talking about income which is repeating every year. And that's why I did not count special dividends, additional dividends, whatever additional dividends, even though it's real money. I didn't count that because we're focusing on the sustainable part of the portfolio, right? The sustainable income which the portfolio is generating. Now, the third and most important statistic is the one which blew me away, right? More than half of the portfolio has actually increased their dividends by 10% or more, right? More than half of them. Now, a 10% increase in dividends is nice. It's not abnormal, right? But the percentage, right? I'm talking about half of the portfolio which reported dividends actually increased their dividends by 10% or more. To me, this is unusual, right? And to me, and which is why the opening line of the monthly update which I wrote to our members this month was that things have never been ever been better, right? I don't use those words lightly because it's actually has never been better. And thus, as you look at all these results and think about the market being all-time high, there's this tension in the stock market, isn't it? On the one hand, you have the SDI going up and up and up. But on the other hand, you have the results which are coming in strong as well. And within this tension, it's making people unbalanced. And when you get unbalanced, you become emotional. When you become emotional, you start to make the wrong decisions. And I think that is really important to address. A lot of people talk about the mechanics of allocating money, but they forgot that there's a human who's actually doing the work of allocating that money. And I think we need to address that. the first thing I want to talk about is really about knowing what you want, right? And one of the best stocks to talk about on this principle, knowing what you want, is a stock called Genting Singapore, right? Why is Genting Singapore so interesting? It's a stock I talked about in Michelle Martin's show about 2 weeks ago. It's a stock which has been left behind in the rally. It's offering 6% dividend yield, probably a bit more today, even though the market's at all-time high. Shares are still well below its all-time high, right? So what is happening here, right? Any investor worth their salt will not look at the 6% and assume that it's free money. Something is happening. What happened? So let me give you a gist of what I spoke about in the radio session, right? In a very simple terms, business suffered during the pandemic, as you can see here. The blue bars, they had to cut their dividends down to 1 cent. And it took 4 years, right, for them to go back up to 4 cents again. And you can see the red line is their earnings per share, right? So they were paying at a rate which was under what they were earning, or paying dividends, which is under what they're earning. But in recent times, they're paying more than what they're earning today. That is why I think shares are valued at 6% dividend yield, because there's substantial concern over whether or not this 6% yield will continue in the future. Second thing also is they are investing in RWS 2.0. This investment will continue probably until 2030 or 2031. And they're building up new things like Super Mario World in Universal Studios Singapore. So when you put it all together, right, there is a payoff coming, maybe 3 or 4 years down the road. There is a dividend which may not be sustainable. And if you put it all together, it all spells uncertainty, right? So where does this stock fit in your portfolio? And the real question to ask is not whether Genting is a buy today at today's price, but the first question you should ask, is Genting the right stock for you? And to do that, you need to know what you want, right? Because as the smart investor, what we truly believe in is that when you build a portfolio, it contains 3 layers, right? At the bottom layer, we have your income producing stocks, reliable, not the fastest growers, but reliable. That's the key word for the income stocks. And once you have this strong base of income stocks, you can layer on the growth stocks, which produce a bit of growth. We're going to talk about that later. But on the final tip is where the speculative stock sits. And for me, Genting is a speculative stock, right? Yes, it's a big business, but there's enough uncertainty in there. There's a possible payoff right there, but also very high uncertainty, right? So the key question you have to ask yourself is whether or not this stock fits what you want, right? Because it's a very different question for a person who has already built their income layer, already has their growth layer, and they just want to add, maybe 0.5% of portfolio or 1% of portfolio into Genting just to test out the idea, right? They can do it. Why? They already have built their income portion, growth portion. They can also choose to ignore it, right? But if you're starting from new, right? If you are investing for the first time, I don't think Genting is the right stock to start with. As high uncertainty, but there could also be a high payout. There's a lot of binary outcomes which could happen, right? So this is what I mean by knowing what you want, right? Everyone is in a different stage of building their portfolio. So not every stock is right for you, right? And for that, you need to know what you want. Now, what is also really important, which brings me to my second principle, is about having the right expectations, right? And when we look at the income side of the portfolio, especially, now what I said was this has to be something which is reliable, will turn up year after year without fail. One of the best examples I can think of is Parkway Life REIT. right? This is a stock which I've owned since 2009, since the great financial crisis. And I think this is one of the handful, I don't know if there are many of them, which have increased their core dividend every year since 2007, right? So we're reaching a point where they're going to increase their dividends for 20 straight years, right? Now, you also notice that over the last decade, the increases haven't been much, right? But that's not the point, right? A Parkway Life REIT is not built to double your returns over the next 3 years, right? The Parkway Life REIT is there to provide you with dividends, sustainable dividends year after year with some increases, right? That is the role of Parkway Life REIT. If you go in with the wrong expectations and expect the stock to go up and double, then you're setting up yourself for disappointment, right? This is a stock not built for speed. This is a stock built for steadiness and reliability, right? Now, even though something is steady and slow moving, it doesn't mean it cannot produce high returns, right? Because I bought shares at 73 cents in 2009. And if you look at the DPU, which have been collected since then, is almost 3 times of that stock. If you look at the share price gain, because as the DPU they pay increases, the share price follows. The DPU gain is, or the capital gain is about $3.76. And the total gains is actually 670%, right? Roughly about 11% per year, which I think can't complain. So my point here is, if you understand and have the right expectation of the business, then you know that something like Parkway Life REIT, the valuation is really important because the growth won't be high, and therefore your valuation has to be more on point. Which brings me to the last layer of the portfolio, growth, right? And I'm going to share with you a stock which we have in the Smart Dividend portfolio. It's something we bought in May 2020, right? So what is that? More than 6 years ago. And that company is iFast, right? Our initial buy was at $1.02, right? Now, you may look at that and think, wow, that's a fantastic price. That's actually not the best price you could have gotten. You could have gotten it at 80 cents, right? But today, share price, last I checked, was $8.94. I have not seen a person which has made this sort of gains being unhappy, right? That my point here is
Happy.
My point here is you can be imperfect in your buy point, but still make really good returns, right? But here's the question which always we get, right? What stock should I buy today at what price? Now, my fear with that question is that you are narrowing yourself up, you're cornering yourself to an outcome which is guaranteed to disappoint you. Because you're asking to buy a stock at a specific point of time, and embedded in that question is the desire to see the gain almost immediately after you buy, right? I can understand the feeling. I understand why. But I think when you buy and measure yourself that way, right, you are setting yourself up for disappointment, right? Because thinking long term is not just about buying a stock and holding it long term. It's about having the courage to follow the business and buy again even as the stock goes up, right? And for the case of iFast, we have actually bought the shares 3 more times, right? In August 2023, and also early last year, when shares went down, portfolio bought again twice, right? Now, you look at this chart and you'll think that, oh, we were really opportunistic, the stock price dropped and therefore we bought, right? No. That may be true to a certain extent, but this here is just the stock price, right? This is what traders look at, the stock price. What we look at as long-term investors is this. This shows the bars show the dividends which IFAS has been paying, right? Right now it's about $10, 10 cents and 10.3 cents, right? They plan to pay 12 cents this year, which will be very nice because remember our cost basis for our initial buy was $1. So 12 cents is going to make our yield on cost more than 10%, right? But you can see that somewhere around 2023, that's when the e-pension business of Hong Kong kicked in, and you can see the earnings per share exploding after that. That is the reason why the portfolio bought more of its shares, not because shares fell, right? And when shares fell last year, portfolio looked at it again. Business seems fine. Stock markets wants to give you a cheaper price. Fine, we'll take it, right? That's why portfolio bought twice again. And that, my friends, is really about thinking long term, right? Because long term is not just buy and hold, right? Long term is buying and following the business over the long term. It's about learning long-term lessons, accumulating your knowledge as it goes, having an understanding at every stage of the company. If something changes, like e-pension for IFAS, then having the courage to act on that information based on what you studied, right? It has nothing to do with the stock price. Stock price is there to support you, right? You can't dictate what stock price you want. You can just take what stock price you have, right? So think beyond just what stock you want to buy today and at what price. Think what's going to happen next, right? You could choose to buy a small position today and then add further on. You could choose to keep more money today and invest 1/3 of your money. There are many ways to go about it, but don't get trapped into the idea that it has to be one decision at one point of time. That, I think, is the road to failure. And with that, thank you, everyone. 谢谢。
Thank you, Chin. Sorry, I was on mute, which is why there was like this silence. Okay, there were so many questions that came in. Thank you so much for sending in all your questions. We always love to hear from you. I did collate some of them and then I reworded them a little bit, some of them, so that we can answer them as a topic in general. But really, I think what really stood out from Chin's presentation is that, it's not so much about the dollar amount, right? Whether you invest $100,000, $50,000, it's not about buying one or two stocks. It's about building something that can work for your financial goals over the long term. So Chin went through all this, you need to think about the businesses, the business itself, how it fits into your portfolio, how much risk you're taking, and whether the income you're receiving also is sustainable. So I think it's all about fitting it together to build a portfolio, something that can work. And so many investors understand that theory. They understand that you need to own quality business. You understand that chasing the highest yield may not be always the best approach. And putting it together in a complete portfolio and having the discipline to manage that also is when things like over the years, it's not just managing it over like 1 or 2 months, right? It's over the long term. We've been running this portfolio since 2020. It's when things become much harder. So, and that's really the main reason why we created the Smart Dividend portfolio. The goal was never to give a list of stocks and say, hey, here, these are the list of 24 stocks that we own inside our portfolio, right? It was, and it still is, to help investors like yourself to build and maintain a long-term dividend portfolio with a very structured approach to selecting the businesses, managing the allocation, and really staying focused through all the different market conditions, right? We lived through, this portfolio survived COVID. It's been for a number of years. So before we move into the Q&A segment of tonight's webinar, for those of you who are interested in taking the next step with us and building a long-term dividend portfolio, we will be running a special sale starting tomorrow. It will be open for 5 days only. So do keep an eye on your email inbox tomorrow. We will be sending out an exclusive invitation with all the details. So, okay, now I will move on to the first question, which is for someone who already has been investing in stocks, what are the biggest mistakes you see investors make when building a dividend portfolio? So, giving you a short break, I answer it first, okay? then
Yeah,
I will give.
thank you.
Okay, so that's actually a very good question because buying a stock itself, it's become very easy, right? You can open a brokerage account, you can search for a company, you can just buy it like instantly. But investing successfully over the longer term is not really about buying just one stock. The harder part is building a portfolio that can withstand, like I said, different market cycles. So you need to think about questions like how much should I allocate to a company? Am I too concentrated in one sector? Are the dividends sustainable? So that's and when should I add more? When should I reduce my position in something? Or perhaps at what point do I sell? So a lot of the investing mistakes don't happen because people cannot find the information. I think in today's right now here today, it's so easy to get information. There's so much more available than ever before. But the challenge is really having that discipline and the framework to make consistent decisions over many years, actually. So again, that's what the smart dividend portfolio is doing, because we found that even though investors are capable of finding like one or two good companies, but the harder part is putting everything together in a portfolio that makes sense and having that consistent process to manage it over time. Really, I think a dividend portfolio should not just be a collection of stocks that happens to pay dividends, right? You need to think about diversification, sustainability of that income that can pay you through different market conditions. So, Chin, do you have anything else to add?
Let me add just two thoughts, right? I think the biggest mistakes which I find investors make is not so much about things they should have known but do not know, right? I think there's a Mark Twain quote which I'm going to butcher now. It's not what you don't know which gets you into trouble. It's what you thought you knew but just ain't so, right? It's not what you thought you knew but turned out to be untrue, right? And I think that's a very good quote to keep in mind because a lot of times we assume that we know something really well, and the trouble starts when we assume that everything's going to be fine. Bank stocks are forever going to go up, and then we just keep on dumping our money in there to back our conviction, and that's where huge mistakes happen. It's not about what you don't know. Sometimes we'll miss out on things, and sometimes there were things which happen which you could not have foreseen earlier, like a pandemic. But it's just the things which you have too much conviction on. So really, don't try to be a know-it-all. Try to be a learn-it-all, right? And I think that's a great way to think about it. The second part of it, and this sort of builds off what Joanna just said, and maybe a little controversial. So Joanna, you're sitting now.
I am.
Do not optimize for performance. Optimize for peace of mind. Why? I think that too many people, they look at the market, they compare, they start doing things like, hey, how come SDI go up to all-time high, but my Genting share lagging? What's wrong with my shares? Right? It's a very, very common behavior. I know it because I thought of it before when I was younger. No? So I think that then or you start to think, oh, these stocks are not keeping up. I should sell them and buy the better stocks, right? And that's where mistakes happen, right? Because when you're optimizing for performance, you invariably be forgetting that your mindset is much more important. And the beauty of it is, what I found is when you optimize for your peace of mind, right? What will happen is you make better decisions and magically your performance actually becomes better, right? So the best protection against any market really is a calm mind, right? Optimize for that.
Oh, definitely. I think that's the beauty about long-term investing also, is that you don't have to worry about what's going to happen to the market the next day, right? And I think that's why we also like our dividends here at the Smart Investor. And that's why we even have this portfolio to begin with, right? Regardless of market conditions, you will still have an income coming in. And it's always good to see the income flow coming. All right. Okay. Thank you, Chin. Next question is, let me pull it out. Give me a second. It's banks. So many people asking about the banks, okay? The general gist is, I already own DBS, OCBC, and UOB. They have done very well. Should I buy more banks? The second one that's very similar is in the same space, is that are bank stocks still quite a few worth buying right now? So I'm just going to answer very, very quickly first. I'll say my piece and I'm going to pass it over to you, Chin. So first of all, congratulations to those who have owned the banks for a long time. Right, the three banks have been excellent businesses, and many shareholders have benefited from their strong performance, especially in recent times, and the dividends also. But before you think about whether or not you're going to buy the bank, I think that when you need to think of it from the perspective of building a portfolio, right? It's not just about, oh, this stock has done so well. Can it still continue? That's part of the question, yes. But how do you build your portfolio, or how can this fit into my portfolio? And such that my portfolio can withstand different market conditions. And also, because a portfolio is not built around whether is it one company or one sector continuing to do well, right? It's built around owning a collection of good businesses that generate income in different situations. So it doesn't mean that, oh, you should sell a company that's doing very well just because it's, you want to balance your portfolio. So it just means understanding concentration risk and making sure that your portfolio is resilient. So that's what I really wanted to say about portfolio building, and I'm going to hand it over to Chin to talk a bit more about the banks.
Ooh, banks. So banks, I think, so basically banks, if you already own them, the question I would ask yourself, and going back to the concept of optimizing for peace of mind, right? Would you be comfortable holding, 50% of your, or let me rephrase, if you have, like, for example, 50% of your portfolio, or even 60%, by the way, close to 60% of the SDI is now all banks, huh? Yeah, just keep that in mind when you buy the SDI ETF. The thing here is thought experiment. Huh? What if bank share prices fell by half over the next 2 years? Will that impact your life? First question you have to answer for yourself, right? And that goes to what's your comfort level, right? Do you feel that you are able to manage this decline? Right? Will your retirement plans, will your financial goals be substantially impacted by such a decline? This is a hypothetical question, not a prediction, by the way. Because if we look at where banks are today, it's increasingly becoming harder and harder to justify today's share price, right? And at the start of the year, right, we could point to high price to book, but we could also point to the high dividend yield. Today, the dividend yield argument is becoming thinner and thinner, right? So my point here is bank share prices cannot just keep on going up without the dividend yield and the business keeping up, right? They have to let the business catch up. And I think maybe the biggest signal is the fact that OCBC and DBS, for example, both of them have promised to return excess cash to shareholders, right, in the form of share buybacks. Are they buying back shares today? By a lot? No, they are not. Which should tell you something, right? But then it begs the question, if banks are not a buy today, should you sell, right? It depends, right? For the portfolio, we have a substantial portion of our portfolio in banks. But we also have we have a nice cash position as well, right? And this goes back to the what I said before, right? It's not about whether you should buy today at this price, but what's your plan after that, right? So for us, banks can continue to go up, which will make us even more uncomfortable, but we're still okay, because any decline in the share price of the banks is something which the portfolio can absorb. And What if bank share prices fall? We have a cash position. We can act on it, right? So for whatever scenario which happens, we know what we're going to do next. And that's the essence of really thinking of long term. Don't just think about what's your step today. Think about what you're going to do after that. Think about what your composition for portfolio is going to be, right? And whether you're comfortable with that.
Okay, thank you, Chen. All right, on to the next question, which I grouped together also. Can you share the 24 stocks in your portfolio? Wait, I'll answer this, okay? Wait. Then there was one more, a couple more. It was about can you tell me what portion of your personal wealth is invested in the portfolio? Trying to understand how much skin you have in the game. So,
Oh, okay.
wait, I will answer, wait.
Okay.
Yes, okay. I want to say first that the smart investor has been investing real money into this portfolio since 2020. So we feel that the best way to demonstrate conviction is with money. So we put our money where put our mouths, right? Where we put money where our mouths are, and then we use the money and we invest every single month. And we've built a portfolio. The size of the portfolio, we can share that, right? We can share that it's around $215,000 right now. And as to the 24 stocks or more details of the portfolio, that's the question. I would say then perhaps you might want to consider joining us, since there's a sale running starting from tomorrow. Members of this service, which is our flagship service, you get full access to the portfolio, including companies we own, what we buy every month, our portfolio updates, and our thinking behind each decision. But it's really, yes, a part of it is the stock names, right? But I just want to share that it's not entirely that, it's not solely that. Why did we pick that company? How much of it did we allocate? When did we add? And when we review and how it works together is also something that I think it's extremely valuable. Because a stock list will just tell you what we own today. The real value of the service is understanding the process behind building and maintaining this portfolio. So again, you can find out more in your email inbox. That you will be getting an invitation to join us. I will be moving on to the next question, which is on dividend yield. Okay, here we go. We have 1, 2, 3, 4, 5 on this. Basically, how do I know if a dividend is safe or if a stock is a dividend trap? Okay. How do you decide when a stock has no more, does not show any more dividend growth or upside, and when to remove it from the portfolio? What do you do with a company that has been increasing dividends and then suddenly cut their dividends? So really, it's about dividend longevity, sustainability, maybe
sustainable dividends.
Sustainability.
Yeah.
Right. So dividends, I'm just answering a part of the question before handing over to Chin, is I think a very important question for income investors. Because when an income investor looks for dividend stocks, one thing that many people naturally notice is the yield, right? 7, 8, 9% can look very attractive. But is it a trap? Because the dividend yield, the percentage, the number itself does not tell you whether or not it's sustainable. So I would say very broadly, and then Chin, you can go into the details. Where does the dividend come from? Is it coming from cash flow? How much free cash flow does the company have? Does it have a strong balance sheet? These are things that we look at. Is the business still growing? Is it still staying relevant? The track record of these dividends over the years. Can the company sustain this level? Will depend on all the factors that I talked about. So sometimes it doesn't mean that a high dividend yield means that it's going to continue on this way. It might not be able to continue, whether it's in the next 5, 6, 7, 8, 9 years. So I think the key here is really sustainability. You're not just here to collect, or rather, we are not just here to collect dividends today. It's to build an income stream that can pay us over the years. So, Chin, maybe just to add on.
So again, the 3 keywords, long-term income, right? And as Joanna said, that spells, if you shorten that to one word, it's called sustainability. So if you look at a very simple mental model, what do you want from a dividend stock? It's the dividends, right? That's the one job a dividend stock must do. So the first question you got to ask is the company sharing its profits, right? Because a company can have a lot of profits, can have a lot of cash, but then they don't share their dividends or they don't pay out any dividends. Now that's a problem. Now, second component, cash, right? For a company to be able to pay a dividend, they must generate cash, right? Dividends come from cash. Now, cash also does not appear out of nowhere. Cash has to be generated by a business, right? So when you go through that cycle back again, you need to find a sustainable business that generates sustainable cash flow, and therefore, and after that, be willing to share said cash flow with you in the form of dividends. So these three components have to work in unison. And as an investor, the first two components, whether they share the dividend with you, whether they have a track record, that's something you can check from their track record of dividends, and whether they increase their dividends when they increase their profits, that's something you can check. Whether it's generating free cash flow, also something you can check. But the last part of it, which becomes more subjective, right? And there's no real like cookie cutter way I can just tell you, okay, these are the few things you should look for and so on. There are many different factors. You can look for companies with moats. You can look for companies with efficient scale, network effects, or long growth pathways, and so on, right? So that's a much more difficult topic, but that's where judgment and accumulated knowledge comes in, right? Because remember what I talked about. As you learn more about the business, right? You're investing in a business. You're accumulating knowledge by following that business over multiple years, right? I've learned about Parkway Life REIT not 1 year, 2 years, but since 2009, right? And watching how management behaves through different cycles, through different difficulties, and that's how you build your knowledge. And that knowledge becomes a reference point so that in the future, when I see a business of similar nature to that of Parkway Life REIT, I can recognize it easier. And that's really the advantage of a long-term investor. It's not the buy and hold bit. That's the action, right? And really, there's no action because you're not doing anything. But it's really the accumulated knowledge and really understanding the different facets of business. And judgment can, of course, go wrong because there are factors outside your control. But so long as you get it mostly right, the results will be, I was really surprised by how good the results were this quarter. But I'm also quite happy because it does show that whatever we are doing is working.
Okay, thank you, Chin. So you closed off talking about results, right? And then I had, because I talked about the portfolio size, so people now are asking. I just want to clarify first while we're at it. I said $215,000. Yes, portfolio size. A little under $200,000 are in stocks. We're holding the rest in cash. So we top up cash every year, and then we invest every single month to demonstrate the effects of consistent investing. And so we buy into Singapore stocks every single month. Dividends collected so far has been over $22,000 from this portfolio since it started. But I think, you can talk about the portfolio size, but I think what's more valuable information perhaps is to talk about the growth rate, right? How has the portfolio grown? So if you talk about compounded annual growth rate, we are at about 11.7%. So in other words, on average, the value of the portfolio over the last 6 years, every single year is been growing 11.7% on average. So those are the numbers. Okay, my next question is on stocks having a good run. So banks and AI-related stocks have had a good run, and REITs are lagging. So there were also a couple of other questions on REITs. When will the REITs catch up, or will they be catching up soon? The REITs have been suffering for some time. Chin, what is your opinion on REITs?
Yeah, I feel you. REITs have been suffering.
We own REITs.
Yes, we do. Quite a bit actually. They're actually one of the biggest contributors to dividends in our portfolio, by the way. Right. So the thing about REITs is, and we actually got this question in our Q&A session with our members recently, right? And the question was, REITs are doing so badly, right? Why should I bother with REITs anymore? Yeah, they seem to be uninvestable. Well, all my other stocks are going up. I think one of you all mentioned banks and AI related stocks, right? No, so why should I? It feels like there's opportunity cost in leaving my money with REITs, right? Which I can understand the sentiment because I've gone through the emotions before when I was much younger in my investing days, right? We tend to compare. We tend to, get jealous with, hey, how come that one moving and you not moving, right? I think that one of the things we have to keep in mind is that REITs were really good investments until the pandemic, right? And to a certain extent, the last 6 years has not been great for REITs. Through, I feel, no fault of their own, right? It has been the last 6 years. If you think about, for example, the malls, right? They were forced to close during the pandemic. That impacted results. They're forced to offer concessions to their tenants, which impacted results. Then just as things were coming out, you have open again, close again, Omicron and all that, right? Vaccination. There was fair amount of uncertainty. And when the road seems to be clear, suddenly interest rates just flew up, right? And I'm not talking about a small increase in interest rates. I'm talking about the steepest increase in interest rates in 40 years. So in this short span of 6 years, right, you have one after the other highly unusual events which has impacted the REITs, right? But my question is, should we ignore the long-term results pre-pandemic since 2002 all the way until 2019, where REITs as a group actually beat the SDI? Should we ignore all that just because the last 6 years has not been good? I don't think so, right? But I also don't think that every REIT is worth an investment, right? Some of the REITs are starting to report positive DPU growth. But again, right, what you do not want is to rely on the kindness of lower interest rates for them to report better results. It is real money, I'll grant them that. But what you want to see is their properties actually doing the heavy lifting and not benefiting from just interest rates alone. Interest rates dropping, everyone will benefit, right? But the real difference and the real essence, and going back to what I said about the three components, right? Do REITs share their dividends? Yes, by law they have to. Do they generate enough cash? Yes, of course they have to, right? And sustainable business, right? The sustainable business part of it for REITs, you have to have assets which demonstrate year after year that it can generate and really bring in revenue and rental, which will sustain these dividends, right? There are a few of them. Some of them are turning around. Some of them got into temporary trouble. So separating the ones which are good, the ones which are recovering, and for good reason, and sustainable. These are, I think, areas where I feel there are still opportunity, right? But again, expectations is really important. Don't expect REITs to just double in 3 years and so on. That's not what they're built for. They're built for yield, right? And if that's what you're looking for, maybe they're a good investment.
They might not be or rather they can be good addition to any portfolio, I would say, given the nature of REITs and paying out that very consistent payment, right?
I would
Okay.
also add that 2 of our REITs actually increased dividends by 10% or more.
I was very happy when they do that. Okay, so
And one of them
very
7%.
quickly,
Yeah.
very quick question.
Yeah.
Long term, people are asking, how do you define long term? How many years?
Oh, because I'm seeing there are people who are in their 70s and so on. I think the act of long term is not just about how much years you have left in your life, right? I think the key here is really about the long term mindset. right? And I can say it's at least 3 years. I could say it's at least 5 years. I could also say 10 years or more. If you ask David, my co-founder, he's like forever. Once I buy it, I'm not going to sell, right? So different people have a different definition of what is long term, right? For me, at least 5 years, right? Why 5 years? I think that a 15% increase in 1 year may not look that great, but you compound it over 5 years, it doubles, right? So that's why I think that the real magic actually appears around the 5 year mark and around the 6 year mark. And as it so happens, the smart dividend portfolio is at its 5 or 6 year mark. We are seeing let me count. At least 5 or 6 of our companies have delivered more than 100% returns. One of them, of course, I've already shared. But that's when real big returns start to appear around the 5 or 6 year mark. But the more important part here is, even if you're looking at it's short-term returns, right? I think having that long-term mindset is really important, because when you have a long-term mindset, if you go in thinking that if I buy this, I'm not going to sell, right? The way you think is completely rewired, and you just think very differently about what stocks deserve a place in your portfolio.
Okay. So yes, I would say that okay, in a nutshell, long term, 5 years or more. And what we always say is that any money that you need
Yes, thank you.
should not, no, in the short term, should not be in the stock market, right? If you're expecting a big purchase, don't use the money that you plan for a wedding, for a holiday that you promised your family you would take them on, for your child's university. Don't put that money in the stock market, right? It does not belong there. It has had a good run, but we still believe that it should be any extra money that you're looking to grow. So, okay, the next bunch of questions is interesting, because I'm going to put it together. The first one is okay, is the smart investor doing dollar cost averaging, or are there really opportunities to buy every month? So I would say, just very quickly, in a nutshell, I think that even if you start off, we always say that we put in cash at the beginning of the year. By the way, in January we put in $20,000, but we don't invest it all at once, and that is what we feel that you should not. That's not how the stock market works, right? We do a consistent approach. Every single month we go in and we look for the best opportunities in the stock market at that point in time. And they really get to the heart. I think these questions really get to the heart of how we should be thinking about growing our portfolio, growing our wealth, right? Because it is not just about investing money regularly. It's about looking at the businesses, and whether or not they can generate sustainable income is definitely one. How are they doing that particular month? And then also depending on the results. These are things that we look at. Chin, I will have you answer that a little bit later on in greater detail. The second one is that, what do you think of putting your money in robo-advisory, or with the projections on the returns? I think that this is a question that's also fairly similar to, how about you use AI also, right? I think that it can be in a way, a robo-advisor. It's one way for people who want broad market exposure and a more hands-off approach, right? And I think that's not, okay, I will have Chin talk a little bit about it, but I was having a conversation with David. I don't know whether you were there, Chin, I don't recall. But David was talking about looking at some of the numbers, right? And it just did not make sense when he was looking at the numbers of the balance sheet of one of the companies. And he had to go and dig and dig and dig and dig before he finally realized why this company was paying out dividends, even though they had no money to pay out dividends. So that was the mystery he was trying to solve, right? But when you use only a human can pull out this kind of things, right? These are the nuances that I think it's good for broad level, right? To use AI to summarize things, but there are certain things that So that was the story that I wanted to share with you. So, okay, I would like to get Chin to answer these questions. I'm just double checking. Yes, Chin, maybe you can answer a little bit more first.
On robo-advisors.
Yes.
Okay, so I'm always an advocate for investing. So even if you want to invest in ETFs and so on, for me, doing something is better than doing nothing. I'm most fearful when people go in with the wrong expectations. We see that in Korea happening, right? People get in, they get burned. 1.2 million people get margin called. And then the saddest part for me is not just about losing the money, right? The saddest part of me is a lot of them start swearing off stocks. They think it's a casino, right? Which to me is the saddest part because you're giving away one of the greatest wealth creation machines in the world, right? And therefore, that really saddens me, which is why uh, I'm very supportive. In fact, I started with unit trust, by the way, in 2002, right? I did dollar cost averaging. I continued that probably until it was 2009. There weren't a lot of options. Back then, no ETFs, but there was only one index fund in Singapore, right? A US index fund. But that was what I did, right? But eventually, I got more comfortable holding stocks because with stocks, one of the things I could see was how much money the company has. I would have an understanding of its business, right? So even when share prices fall, right, of say a Starbucks or whatever company, right, or a I don't know, Sheng Siong, if share prices fall, I could see, oh, it seems like there's still a lot of people shopping at Sheng Siong, and the company is not dead, it's still there, right? And they have plenty of cash on their balance sheet. They are generating a lot of free cash flow. I felt more comfortable with that. And that's why gradually I just moved out of ETFs and invested more into stocks, right? Uh, the one thing I think you may want to look at, because one of our members just wrote us questions based on what ChatGPT said, right? One thing I realized about ChatGPT's answers, right? And I extend this to robo advisors as well. They are very good at describing the mechanics of what they are doing, but they may not capture the psychological effects of what is happening in the stock market, right? Because many years ago, I remember taking a quiz, right? And I'm sure you may have seen this before. They'll ask you questions like, what will make you uncomfortable? 10% decline, 20% decline, 30% decline. And that's their risk checklist, right? They're trying to figure out what sort of decline will happen for you to feel uncomfortable. The problem with such a question is until you fall off your bicycle, then you know how much it hurts, right? So it's like me trying to describe to you how painful it is. It's like me asking you, what's your level of pain after you fall off, before you fell off a bicycle, right? And that's a really hard question to answer, which is why, going through this journey of investing for the long term, you learn things about yourself. You learn where your pain thresholds are. You learn what sort of things makes you uncomfortable and where you should pull back and get comfortable again, right? And it may be that you need to build a continuous stream of income. I have friends who quit their jobs and got very uncomfortable with the fact that they're no longer receiving a salary, right? So their solution could be build a portfolio which pays them dividends. There could be people who have a lot of cash and they feel more comfortable with cash. Fine. It's not the most optimized, but it's the most optimized for your peace of mind. That is also fine. So I think that don't forget the psychological part of it, because this part is not easy to answer. It's something only you can answer. And I think that's why I talk so much about it, because
Yep.
it's something which people don't talk about.
Thank you, Chin. We have the next big question, right? Everybody's asking. Actually, even if I don't ask you the question, you think you can guess it? It is about the market has already gone up so much. It is still good, still a good time to invest. I think it is applicable not just for the stock market, right? The questions are also on specific stocks. I mean, when even in our daily interaction, people are always asking us like, "Hey, this stock went up so much. How still can buy or not?" Right? The market went up so much. How still can buy or not? So everyone's asking this question. I think the difficult thing about investing is that the perfect time, right, to invest becomes usually, like I feel, becomes obvious only in hindsight, right? If you look back, hey, I should have like thrown everything in during COVID, right? It's perfect timing, right? If I had known, right? But during COVID, there was fear, there was uncertainty, right? People are like, oh my goodness, is the market's in free fall, no? Is it going to drop even more? And then the Singapore stock market's not coming up. What are we going to do? So I mean, that's that, right? You will never know until it happens. So today the market has recovered strongly, uncertainty has changed, and then people worry that they missed the opportunity. So I think it's not so much whether or not the market has gone up, but it's what are you investing for? What is your time horizon? We have questions about people asking us, oh, what's long term? But really ask yourself, how long do you see yourself investing for? Right? If you're investing for the next few weeks or months, then of course market timing is very important, right? If you want your money like really soon. But if you're investing with a longer term mindset, I think the focus then shifts, right? You're not so much asking about, oh, is now a good time to buy? The question changes to, is this business good to buy? Can it continue to win? Can it continue to generate cash flow? So instead of trying to predict that perfect entry point, Chin was talking about, we don't even, we are all humans. We can never get it correct 100% of the time. You can never get the perfect entry point for iFast. You can never get the perfect entry point for DBS, even though I would have loved to get the perfect entry point for these companies, right? So I think successful investing is not about making that one perfect decision. It's about making enough good, solid decisions consistently over time, right? And having that discipline to stay, having that discipline to review, and making sure that it still fits your long-term goals. So, Chin, so how is it still can buy?
I put it this way, I'll be very honest, it's getting harder to find good opportunities, right? But then again, the portfolio is going to buy 2 stocks today, or starting from today. And we are still finding some opportunities, but it's the sort of pool of opportunities is becoming smaller and smaller. There are, but it's becoming smaller, right? We are still able to keep our pace of buying 1 to 2 stocks, even 3 if the opportunity arises. But the pool of opportunities is definitely becoming smaller. Should I also answer the question, should you sell? Seems like it's connected.
Yeah, would you sell? Should I sell DBS? We bought iFast at, what do you say? How much was it? $1?
Let's talk about DBS, right?
Would you
Because
sell?
I do remember when it was trading at $35, I felt it was getting a bit expensive. And if you find hindsight, you say, oh, Jim, what a dumb idea to say that $35 is expensive, right? But if you go by book value, right, it was, moving above its average trading range, right? Today it's almost 3 times its book value. Its average is around 1.5. So shares have increased, not because the business has improved, it's because the multiple has actually increased, right? So you should be really aware of that. Which begs the question, then should you sell? Does it mean that, I thought it was expensive back then and it worked out? So does it mean I buy again now and it will work out again? No, I didn't say that, right? Let's be clear on that. What I mean is you should take every stock as though you have seen it for the first time today. Imagine if you have never bought shares of DBS today, right? And then ask yourself, would you buy it today, right? And I think that will be a very clarifying question on whether you act on it, as to whether you sell or not. There are many different ways you can think about it, right? There are people who may have already fulfilled their financial goals. They're happy with the capital gains which they got from DBS. They're happy to sell all of it, put it into bonds, and the bond return, even though it's low, is enough to cover their financial expenses. Maybe that's a good move for them, right? Peace of mind. Remember that. Always remember, stocks are just vehicles to get you to where you want to go. It's a damn fine vehicle, but it's not a vehicle which you have to take all the time, right? You if you're looking, I think that if you choose to sell, be very clear-minded of why you're doing it, right? If you're selling because you're fulfilling a need, a financial need for yourself, I think that's a really good reason to sell, right? Now, once you sell, don't look at the stock market again now, because in 10 years' time, probably the stock market will be up again, or maybe 20 years' time, it'll be up again. That's the nature of stock markets, right? But look at what your needs are, right? Let that be the anchor, that North Star of how you make decisions. And I think that's the best thing you can do for yourself. And last comment on whether you sell banks or not. When you decide to sell, if you decide to sell, and I'm not advocating selling, right? But I know that some people out there, they may choose to sell. Start from, you remember the portfolio, that pyramid? Start from the top first, right? Speculative, sell the speculative bits of it. Sell the stocks which are not performing, which are underperforming, chronic underperformance. Let go of those first. Don't cut your flowers and water your weeds, right? Keep your flowers alive, because those are the ones which will probably generate better returns for you in the future.
Yeah, exactly that. All right, thank you, Chin. I like the way you talked about to make it very clear, is to say, okay, what if I'm looking at it with a fresh set of eyes, that I don't own it already. What would I do? What is the action that I'll take, right? Okay, so the next batch of questions is around how can the smart investor add value to us? Well, can you tell us what stocks or allocations you need to form my portfolio? Does it include other asset classes like bonds, or just SGX equities? Okay, another question is, it's difficult for normal people like us to keep a close track on the performance of the companies and make decisions to buy, hold, or sell. Does your team provide support here? So I think it's very good questions, right? Because wait, I think there was one more question, sorry, about our performance, the performance of our portfolio. It was also asking in comparison to the STI. So I will answer that. It just popped out on my screen. Yep. Okay, so I think I talked about this, in that finding a stock idea is not the hardest part about investing today. It is because there's so much of information available, right? It's really building a portfolio that makes sense as a whole, and knowing what to do when the businesses and conditions change. So we do that here at the Smart Investor. We not only review the portfolio every single month, the stocks in the portfolio every single month. We also share our thinking behind the decisions that we make, whether we add or we hold. And also we run a Q&A session every quarter to answer questions specifically relating to the companies within the portfolio. So in terms of asset classes, the Smart Dividend portfolio focuses on Singapore listed dividend paying stocks, companies rather, and we have a US growth portfolio that Chin hits, that covers US growth stocks, and then we have other portfolios that cover different markets, but generally, yes, we focus on equities in general, stock market. Performance here. I think I talked about the CAGR, or the compounded annual growth rate of our portfolio, is 11.7% over the period of time. In the same period of time, the STI, the performance of the STI translates to around 9.9%. So we did outperform the STI by a little bit. So that is our performance. And I would say those are the main questions. Chin, would you like to add in anything else?
No,
Any
I
other
think your
comments?
answer really covers. I would damage your answer by saying more because I think it was a perfect
Okay,
answer.
thank you so much. I think we've run out of time. We actually answered so many questions, and we actually took note of all the questions that came in. We actually do cover a lot of content on our free website, thesmartinvestor.com.sg. So whenever we run things like that, it's good for us to hear from people what you're thinking, right? And then what we'll do is sometimes we write content that hopefully answer some of these questions on our website. So really, thank you so much for joining us this evening, and we really appreciate you sending in all your questions and spending your time with us. Do remember that we will be sending out invitations to our invitations to join us at the Smart Dividend Portfolio tomorrow in your email inbox. So from all of us at the Smart Investor, thank you for joining us and take care. See you again. Bye-bye.
Thanks, everyone. Thanks for spending time with us.